This is a webinar and not a meeting, which means you can see us and hear us. However, we can't hear you or see you, or you can't see each other. If you have questions, please ask via the Zoom function, or else you can email either myself or Eoin. We have two experts today, Eoin Buckley and Diarmaid Colreavy. We'll take their questions after Diarmaid's presentation. So I'll start now with introducing my colleague, Eoin Buckley.
That's great. Thank you, Sean. So firstly, what I'm going to do here is share my slides. Okay, so look, the topic for today, right, I'm going to talk about retirement options. So this first slide here is a slide that we would have looked at previously. So if we look at that middle box, this 800,000, that's the example really for most of my slides today of somebody, let's say age 65, 800,000 is the amount in the pension fund and their options from this point on. The boxes above that were the building blocks as to how they got to that in the most tax efficient means possible. But we discussed that around about 12 months ago in detail, and that recording is up on our website. So today we're moving down the page and down bottom left, they would most likely be taking a 25% tax-free lump sum of 200,000. So down in that bottom right box, that's 600,000. This really is the focus of what I'm talking about today, and their choices as to what to do with it, be that annuity, ARF, vested PRSA, or possibly even a combination of all three, right? So just to mention the annuity option, and just to, it's been around since the year dot. So the idea here is that when you accumulate your defined contribution fund, you exchange some or all of that for a guaranteed income for the rest of your life. So the advantages are you get certainty of income. You're no longer concerned with any future investment performance. And then look, the disadvantages, you've no access to that capital anymore. You can't withdraw a lump sum. You can't invest it. And I suppose sometimes the big turn-off for annuities is that the annuity dies on the death of the annuitant. So there's no capital preservation for the next generation. So now it does give you certainty of income. So what is the price of that certainty of income? So if we think of this from the point of view of the actuary who's working in the life company. So he's setting the annuity rate. So what are the factors that are influencing the number that he comes up with? So one item would be interest rates. Are they low? Are they high? Or more kind of even specific on that would be bond yields. He'll be quite interested in long-term bond yields, maybe 20-year, 30-year, because what he'd like to do is have a high interest rate, have a high bond yield, and be able to stick your capital in there and gain some money on it, and be able to give you a better annuity rate as a result. Date of birth is going to be important. How long, the actuary is going to look at how long am I likely to be paying this money out for? Is it level or increasing? So level would be, let's say you had an annuity of 10,000 a year. It's 10,000 every year. It never increases. You can increase it, but the annuity rate will come down, and we'll see a couple, an example of that. Guarantee period, this would really only be of any significance if somebody were to die young, right? So you could have a guarantee period. The max you could have is 10 years. So again, if somebody had an annuity of 10,000 a year and they died after 6 years, they would have received 60,000 in their lifetime. The other 40,000, the remaining 4 years to get from year 6 to year 10 at 10,000, at least that does get paid out by the life company. At least there is something there for those left behind and survivors. So then is it a single life or a joint life? So typically if somebody is married, they are going to opt for a joint life, so that if they predecease their spouse, that their spouse takes over annuity income. So then the spouse's date of birth is going to be important. If they're quite young, then the annuity rate is going to be lower. And then the reversion rate to the spouse. Do you want, on your passing, do you want your spouse to get half your annuity or all of your annuity? So you are buying certainty, right? The annuity rate, once you purchase it, stays the same for life. So let's have a look at just some of those rates. So um, on the single rate annuity, if somebody gave up 100,000 of their capital, they get an annuity rate of about 5.4. So they get 5,400 per annum every year until they die, right? So if they're married, they're most likely going to go into column two. They're going to add in their spouse. The annuity rate comes down, but not by a huge amount. It comes down to about 5%. And then the third one is where they're giving a bit more of that annuity to the spouse. The guarantee period is now 10 years, and the spouse will get 100% your annuity. So the annuity rate comes down a little bit there again. Where it really comes down is where somebody, I suppose, it's a reasonable request that I'd like my annuity to increase at maybe 3% per annum to keep pace with inflation. So look, the actuary is looking at that, and he's going to get caught out if that person lives to a long age, because you have 3% compounding and compounding, right? So that starts off at quite a low rate. So thankfully, we do have options other than the annuity. So since April 99, we have the ARF option. So we've Charlie McCreevy to thank for this. It's very useful, and most retirees, I find, they tend to opt for the ARF. Now, not all of them, but as I said, the turn off in the annuity was that the annuity dies with you. With the ARF, it does not die with you. The fund continues. Most likely, what would happen is a spouse would take over the fund, and then on the spouse's passing, you're most likely going to leave it to children. So depending on the tax treatment, there would be if the child is over age 21, they're going to be into income tax at a special rate of 30%. And if the child is under age 21, they're going to be looking at a taxable inheritance, so capital acquisitions tax. So look, the advantages, you retain access to the capital for your lifetime. You can withdraw a taxable lump sum, and capital preservation for the next generation. So then look, the disadvantages, you've no certainty of income, right? Because your money is invested in the market. So you could have a situation where your ARF fund goes to zero, right? And you're still alive, right? So that could happen for a number of reasons. Maybe the fund wasn't that large to begin with. Maybe the withdrawals you took out were large, or maybe the investment performance was poor. So you are always going to have one eye really, or two eyes, on the future investment performance, because it does affect you in the ARF. So we have a vested PRSA option, quite recent, 2024, similar to the ARF, a little bit of flexibility in that you can have multiple PRSA policies, and we'll have a look at that in a little bit. So why so many rules, right? I think that would be a good question to ask. So initially, right, the idea of the annuity was that, look, the sole objective of a pension fund is to provide someone with a guaranteed income for life. Okay, so that seems straightforward. The bit about where your annuity fund dies with you led Charlie McCreevy to change the game. And like we're used to in this industry, lots of reports and lots of recommendations, most of which never quite get implemented. There wasn't even a report before the ARF. It was kind of at the whim of the minister at the time, and he had some ideas of his own. He thought it was paternalistic nonsense for annuities to be forced on life companies. And he said retirees are grown-ups and they should be treated as grown-ups. It's their money. They should be allowed to decide what to do with it. So we're very clear on his thinking, and we're lucky to have that as an option. In 2003, the PRSA, this was an attempt at pension simplification. Now, people like myself and Sean working in the pensions industry, we do smile when we hear pension simplification, because this was an example of, at the time, I had about 8 products to talk about. Now I'd one extra, right, a PRSA. So it didn't seem like things were simplified, but it definitely gave us more options. So in 2006, there was a Department of Finance had a review. They noticed, I mean, it's funny to look back on, the ARF had become too successful of an idea. They spent years trying to get people interested in pensions. Then they came up with the ARF, and they kind of said, "Whoa, there's too much activity here. This has become too successful." So they found two extreme cases. There was two individuals with 100 million euro in a pension fund. They matured it and took 25 million of a tax-free lump sum, 25%, and 75 million into an ARF. So look, they were clearly going to put a stop to that, right? So a couple of rules quickly followed. Imputed distributions, where they were going to where they now force people to take 4% in their 60s and 5% in their 70s. That's to get some taxable income off us, because in those two extreme examples, they weren't withdrawing any money, they weren't getting any taxable income. So then the standard fund threshold, they put a limit on the amount that you can have in your pension fund. So that is now 2.2 million. And on the rise, there's a commitment for that to increase by 200,000 over the next couple of years to get to 2.8 million by 2029. And then they also put a limit on the maximum tax-free lump sums. So the max tax-free lump sum is 200,000. It is possible in certain situations, limited situations, to get another 300,000 out at the standard rate of tax only. But that would be normally in a situation where you're looking at a €2 million fund, and 25% of that fund gives you the 500,000. So you can get 200 tax free and 300 at the standard rate. 2024, the vested PRSA became a lifetime product. So before that point, if you were in a PRSA at age 75, you had to get out of the PRSA and go into an ARF. Now you can just stay in the PRSA, and it goes from unvested, which means unvested means you haven't taken your tax-free lump sum. Vested means you have. So the three big pension trends, right, over the decades, there's been a big decline of defined benefit schemes. And some of the reasons for that was when interest rates went really low, and even pre-COVID times, interest rates were at zero, right? So it meant that the annuity rate was really small. So the cost to fund that, you needed a huge fund to fund that annuity. So a lot of defined benefit schemes went bust, or a lot of them just wound up the scheme before the scheme did go bust. And that led to the rise of the defined contribution scheme. So I suppose, a big trend now is that we have what I would say capitalization of retirement provision. So what I mean by that is, in the old days, it was about having an income that spread over your retirement years. Now you get a big ball of capital at retirement age, and it's up to you to decide what to do with it. So point three links into that, right? That very much transfers all of the investment risk, all of the longevity risks. By longevity, I mean, is there enough money to see the person out, right? Because we don't know what age anyone's going to die at, right? So all these risks have now gone on to the individual, right? So that does make it, I suppose, a complex subject when somebody gets to age 65, right? So planning for a tax efficient retirement, right? So this would be very much being aware of your standard rate band of tax and where you're fitting in with that, right? So an individual can earn 44,000 at the low rate of tax. So as a couple, you could have two amounts of 44 coming into the house. And I mean, even just to look at that 44,000, standard rate tax means 20% tax only, right? So that's a little bit over 8,000, right? Now, going against that 8,000 is you'll have a personal credit for 2,000 and a PAYE credit for another 2,000, right? So you've only about 4,000 income tax to be paid there, approximately. A little bit of USC, PRSI, but only up until age 66, or when your state pension begins, PRSI will disappear. So that is very tax efficient. You're getting a lot of your money there as net pay, right? So for couples, when they get married, couples or civil partners, that 88,000, they can slice and dice that a small bit, right? The higher earner can have up to 53,000, and the lower earner can have 35,000, so they can get to 88 that way. They don't necessarily have to have 44,000 each. So just to bear in mind, the state pension is about 15,500. So that will form part of that 44,000 standard rate band. So I suppose the idea here is that you're drawing out money from your pensions. If you have, 15,000, you've 29,000 left of your standard rate band. Maybe you dip into your pension fund and possibly take out 29 to hit that standard rate band of tax. So then PRSA flexibility, right? So this would be normally in a situation where you're dealing with a very high pension fund. I mean, one or two examples. I had a couple of people that were at the 2 million level. So rather than have one retirement event where they will end up with an ARF of 1.5 million and be forced to draw 4% of that in their 60s, which would be 60,000, and it goes up to 5% in their 70s. As a pre-retirement transaction, what we did was we moved it into 5 different PRSA policies, so they could have 5 different retirement claim events. So they could go at the first policy and just activate that and leave the other ones untouched, right? So they could have a mixture of vested and unvested PRSAs up to age 75, but that all that plotting and planning does end at age 75, as all policies need to be vested at that point. So just have a look a little bit about projections. I mean, you will, when you get your ARF policy documentation, there will be, you know, a projection in there, a statement of reasonable projection. And we have, you know, little bits of software ourselves, myself and Sean, that we can use. And just, you know, if somebody wants an idea of what is their cash flow going to look like in retirement. So look, this example is 600,000 of the ARF. You can see there at age 65, they're getting 4% of that. So that's about 24,000. You can see the state pension kicking in then. There's an assumption that that rises at 2% every year. You'll see the green line is their ARF drawdowns. You'll see that increase at age 71 because that's going up to 5%. So look, this does give you an idea. They even give us a line in the sand there around age 90 where you're expected to kind of keel over and die, right? So then when we look at the declining fund, you should expect, I suppose, your ARF fund to decline, right? So this says we saw in that example what were the cash flow, you know, items coming out each year. So let's have a look at your fund, right? So that projection would suggest that we have two growth rates. One would be a high enough 5%, and we have another 2.65% number. So if you look at the 2.65, you're expecting that to decline because you are taking 4% distributions and 5% in your 70s. There's also an annual management charge to come out of that. So it's growing by less than that, 2.65. So you would expect your fund to decline. So in this situation, the projection is saying that the fund at about age 90 would be about 240,000. So then that would pass on to a spouse, as mentioned, or children, right? So just, I suppose, a bit of a caveat when you're looking at projections, right? They are based on assumptions. And this one, a linear, you know, growth rate of 2.65, right? So the projection is just going with if your fund grew 2.65 every single year. Now look, I can tell you now that's definitely not going to happen, right? The rates are going to be up and down. So this was an interesting slide, a bit of an extreme example, right? So it just shows timing. So we've two investors here. They each had €1 million invested in the S&P 500. So look, like I say, it's an extreme example. A retiree is unlikely to have 100% equities, right? But look, it does serve as an interesting example. So down at the bottom line, the black line, we've somebody who retired at the end of 1999. So they were very unlucky with the timing of their €1 million. That was just before the dot-com technology bubble burst, right? So you can see after 20 years, they just about have that million, whereas the top line was at the end of 2002 after the bubble had burst. So his million basically got a lot more for his money, right? Prices were cheaper. And then 20 years later, he's up at 4 million. So that's an incredible divergence. And I suppose my caveat around projections is they both would have received the same projection when they started. And obviously their outcomes were radically different. So planning for that investment risk. So some points we'd say, look, I suppose when we're planning for investment risk, we're saying you don't want to be the guy in that black line, you know, with the bad timing when he went all into equities, right? So you're going to align your risk attitude and your capacity risk with your choice of funds. So highly unlikely a retiree is going to have 100% equities. We can see the 5 asset classes. They might, you know, have a little bit in cash. We can see the deposit rates around 2%. Bonds, German government bond, 10-year yield on that's about 3% to give you an idea of likely returns. Equities is the one that moves up and down, but is the one that it proves to be the engine for growth over the long term. Property alternatives getting a lot of news. Last year we'd gold and silver bringing in incredible returns. They've fallen off a bit. They've lost a bit in the last month or two. And of course, the big story now is the price of oil. So there are multi-asset funds for all risk types. Sequencing of withdrawals. You could have more than one fund. You could have a lower risk, lower volatility multi-asset fund, and you use that to take your drawdowns, leaving maybe the higher risk, the ones with more equities in them, untouched, certainly over the short term. So look, those ideas, they would have saved money for the 1999 equity investor, right? But just to mention, they would have cost money if for the fellow who invested in 2002, right? Because what these risk reduction ideas do is they're decreasing your equity content, right? So if equity markets are falling, that was a good move. If equity markets are rising, not such a good move, right? So items I didn't cover today. I didn't talk about what happens to a pension fund on death. Well, I suppose I did talk about the ARF, but I went into it in more detail in a pre-retirement setting in our 2024 webinar, and into a lot more detail on death in our 2025 webinar. Lump sum choices at retirement, I just assumed we're taking 25% of the fund, which is what happens in most of the cases, but not all. Sometimes in a defined contribution scheme, you might look at the 1.5 times salary option, right? Impaired annuity rates, that's something where somebody's health is poor to the extent that it restricts their lifespan, right? So a life company might look at giving an increased rate based on a health assessment. Now, what I would say there is you probably shouldn't be in an annuity anyway. ARF is going to make more sense there. I didn't look at defined benefit schemes today. So look, the items I did cover today, we looked at our options at retirement. We went through the annuity, the ARF, the vested PRSA. We looked at all the rules and why they exist. We looked at our pension trends that shows all the decision making and risk going on to the individual. We looked at a bit of tax efficient retirement planning. We looked at some projections and just the caveat with the assumptions, and we looked at some risk reduction ideas. But like I say, no such thing as a free lunch in investment markets. They would have helped one guy in our example, and they would have harmed the other guy. So with that, look, thank you for attending today in such large numbers, and I'll hand you back to Sean.
Thank you, Eoin, for your insights. And so our second speaker today is Head of Equity Analysis at Cantor Fitzgerald Asset Management, Diarmaid Colreavy.
Perfect, thanks,
Okay,
Eoin. And we
great.
can actually just jump straight to slide 5, please. Just for the to set the scene on where we were kind of coming into the year and coming into this conflict in the Middle East, which has really superseded anything that's happened beforehand. So we were actually quite cautious coming into the year because we thought there was a lot of complacency out there. And we felt that a lot of the points people were pointing to for optimism, strong earnings growth, strong GDP growth, possibly rate cuts on the way, AI obviously being a big driver. We felt they were the reasons that the markets did so well last year. If you remember, it was actually this day last year was Liberation Day, and the peak of the kind of panic around Trump's tariffs. And the market then went on to have a great kind of 6 to 9 months. And we felt that was the reasons in that slide there are the reasons the market did well last year, and not necessarily why it would continue to do well this year. So if we go to the next slide, then we actually felt that while some of those points were true, there's a lot of complacency. Markets were expensive, record high valuations, and investor positioning was kind of all in on equity. So a lot of complacency. We felt the rate cut, kind of bets that were being made in the market maybe looked misplaced. Inflation starting to rear its head again. We felt the earnings forecast for double-digit earnings growth looked overly optimistic, and the pace of the AI build out maybe starting to decelerate, and also given the funding of it was starting to shift from equity to debt fueled, that obviously added some risks to that. So the next couple of slides then just kind of indicate where positioning was, record low cash levels. So if you invert that, basically means investors were fully invested in the equity market. The next slide shows valuations. So if you look at free cash flow yields, record lows, price to sales, or you could look at price to earnings, record highs. So again, just not a great starting point going into the year, and certainly as we've seen a crisis in the Middle East, which is essentially a global energy and supply chain shock. So if we look at inflation then on the next slide, there's certainly a disconnect, between what central banks look at and what us as consumers feel. Central banks were kind of happy about where inflation was. I don't think any consumer, since 2022, seen prices go up consistently, thought inflation was in a good place. And we could certainly see it starting to hit consumer stocks on their earnings calls, and just consumer confidence levels. So while the rate of change in inflation had certainly stabilized, given prices were still going up on an absolute basis, we thought that was an issue for the consumer. And we also felt that the central bank forecasts were probably being overly optimistic, because we were starting to see companies talk about their input costs kind of creep up. And this was before the Middle East crisis kicked off. So that really has, supercharged this inflation problem. So if we go to the next slide then, which I think is, if you're to take one kind of takeaway from today, it's that this is going to affect everything. There's no industry that escapes this. So we're essentially losing about 12 million barrels a day in a 100 million barrel a day oil market. So about 12% of oil has been taken offline. So the IEA were in the news yesterday saying that this is actually a worse crisis than the 1973 and 1979 crises, which were obviously huge global events and led to recessions. So if you look at the kind of historic kind of correlations, a 1 million barrel a day swing in the supply demand balance of oil typically adds $15 to $20 to the price of Brent. So if you think we're losing maybe 10 to 12 million barrels, it suggests that the oil price is going to go a lot higher. And up to now, the US administration have actually done a surprisingly good job at talking down the market, certainly the futures market. But if you look at actually physical premium that real buyers of oil are having to pay, if you're a refiner in Asia, you're actually having to pay a large premium to the prices we see on our screen. So you might actually be having to pay $150 a barrel. And you can see the prices of jet fuel and diesel. Diesel in Europe touched $200 for a delivery today, which is a record high, back to kind of 2022 levels when Russia invaded Ukraine. And this is a much bigger supply shock. And if this disruption persists for another few weeks, which listening to Trump last night or any of the noise out of Iran is I think clearly the base case, the global oil supply chain risk breaking down, and you're starting to see in Southeast Asia, demand rationing, people having to work from home, flights being cancelled, etc. And if this continues, we're going to see the same thing in Europe. So we could unfortunately be heading towards an energy crisis that we haven't really seen since the 1970s. And while today the biggest problem is obviously jet fuel and diesel, as I mentioned, in Asia spreading to Europe, Asian buyers now are unable to source LNG from the Middle East, given the outages in Qatar. So about 20% of Qatar's LNG has been taken offline. They said that could take years to come back. And more importantly, they were planning on adding more LNG capacity, which was supposed to solve our gas problem in Europe, given the Russian supply being cut off. So that release valve for us has now been cut off. So we've actually been quite lucky in Europe that since 2022, the winters have been relatively mild, and we haven't had some of the more extreme, heating demands over the winters. But if we get a bad winter now without that Qatar supply coming online, could be a big problem down the line. And even before that, European electricity prices are based on essentially the marginal cost of gas. So if that's been bid up in Asia, it means our electricity prices will go up. And obviously we're starting to see that already. And then the petrochemical demand, the byproducts, they touch every physical good we purchase from, our phones, our runners, medical equipment for hospitals, autos, farm machinery. There's a helium shortage we're starting to hear about that threatens to halt the semiconductor production, which obviously it's been that semiconductor build out, the AI build out that's essentially driven global growth for the last number of years. So if that comes to a halt, that could be a big problem. And then one particularly thing to monitor, if you look at the next slide, is fertilizer. So global fertilizer supply has been impacted, which means food prices are going up, basically. Nitrogen products like ammonia and urea make up about a third of farm production costs, and they're all driven by the natural gas price. So if there's any disruption there, the Gulf is a big supplier. That's gonna drive up the price of commodities. So for corn in particular, the northern hemisphere planting season is beginning at the moment. Obviously, their supply was secured before this kicked off. But Brazil, who are the second largest corn exporter, they usually start sourcing now for their autumn planting season. So unless this is resolved very quickly, which is obviously looking unlikely, this is going to be a big problem into the second half of the year and early next year. And then the next slide just shows various other we could show you, I mean, tens of these charts, but essentially it's just from aluminium to the crack spreads, as I mentioned. Everything's been impacted. The other point is obviously the Gulf countries who are being targeted by Iran. They've actually been big through their sovereign wealth funds. They've been big backers of the AI build out. They've funded a lot of data centers, a lot of AI startups, a lot of software companies. Like the Gulf are some of their key funders. We're starting to hear, there's obviously been noise about private credit, particularly in the US. They've been big underwriters there as well. So if they start to obviously reallocate their budgets for issues at home, that could become a broader issue in private markets. And then the next slide is just like typically when we see inflation picked up, as I mentioned, we do see a pullback in durable goods and consumer spending. And maybe an underappreciated risk is essentially since COVID, we've seen a big pickup in retail investing, particularly out of the US. But what we saw in 2022 when inflation spiked is obviously as the consumer feels the pinch, they pull back on their investing and trading. And actually, the rally we saw last year, particularly since last summer, was largely driven by systematic investors who just follow essentially momentum CTAs and retail investors. Retail investors in the US are a huge, about 20-30% now of the market. So if they start to pull back, it's a problem for a lot of equities. So we feel at this point it's a time to have a defensive posture. We're at the lower end of the risk range in our multi-asset funds. We own oil, we own commodities. Within the equity mix, obviously there's a lot of headwinds I flagged there. There is obviously some opportunities in terms of the energy sector. The oil majors, while they'll be quiet about it, are going to make a lot of money out of this. They'll use that to deleverage and return a lot of cash to shareholders. The oil field services, obviously oil now in the Middle East will probably always have some risk premium attached to it, regardless of what happens. So in Africa and Argentina, there's going to be a lot of new oil development, so they'll benefit from that. A lot of the miners will do well from, the copper, the aluminium shortages, even coal, which was essentially being shut down. There's talk now of Germany postponing, closing down some of their coal plants. The renewable side, which was very popular investment kind of 5 years ago, we think that's coming back. We're seeing a pickup in solar and wind turbine demand. So again, the utilities will do quite well out of that. European and UK banks, believe it or not, which were the kind of viewed as some of the probably the riskiest sector kind of in the last decade, they're now almost the safe havens. In the world of higher interest rates, the impact for their net interest income is huge. So even if lending probably slows down a bit, just the money they make in this interest environment is actually quite staggering, and they're probably going to be delivering kind of double-digit returns to shareholders through dividends and buybacks. So in a world where this more cyclical parts of the market are at risk, that's quite an appealing sector, we feel. Defense spending, of course, with Trump talking about pulling out of NATO, and just the conflict obviously in the Ukraine not going away, Middle East, EU spending in particular, defense budgets are going to go up, so there's opportunities there. The utilities, as I mentioned, will benefit from the renewable build-out and power prices. And then AI, as I touched on, there's a bit of short-term headwinds in terms of, particularly the Middle East funding. But if you look at actually the progress the developers of AI are making, particularly Anthropic, since the start of the year, there's been staggering progress even in the last 3 months. It's almost every second day Anthropic are releasing a new product on the enterprise side, and we're seeing that software stocks getting obliterated. Because just the LLMs now can do so much of what they used to do. So enterprise adoption is actually accelerating. And these shortages in memory, semi-cap equipment, even old-fashioned, CPUs that go into your computer, that AI infrastructure, we think, is very interesting, and it's definitely going to drive the market on the 3 to 5 year view. But we just think tactically, given the risks I outlined, we might get a better entry point for those kind of secular winners. So I appreciate there was a lot to take in there, so I'll stop and take any questions. And sorry, maybe just on bonds, I know people are interested. So we feel obviously long dated bonds have spiked, yields have spiked since the conflict started. given the oil price shock. But we actually feel long dated bonds here, 5% in the US, UK, over 3.5% in Europe. We think that's actually not a bad place to hide, because we think up to now it's been pricing in the inflationary shock, but we think the demand destruction impact will start to be priced in soon, and actually interest rates maybe start to level off soon enough, and bonds here actually aren't a bad place to be.
Actually, Diarmaid, just while the slides are up there, right? I just moved it to the slide on the range of multi-asset funds, where you use the multi-asset fund 30, 50 and 70, right? So 30 means, approximately 30 in growth assets, equities, maybe not fully, but that's the idea. And 50 obviously is 50% in growth, and 70 is 70% in growth. When I looked, I'd say, I don't know, at some point last year, you were holding probably 6 of the Magnificent Seven stocks. I think maybe Tesla was the one you weren't holding. Am I right in saying that you hold none of the Magnificent Seven currently as we're talking today?
Yes, so we actually recently just bought a small bit of Microsoft, and that's the only one we own. And just because it's come off so much, it's derated. It was probably at a high 20s PE when we sold it. It's down to kind of a high teens PE now. Sure. So just as a kind of almost more as a defensive position, a place to hide, because they're spending a lot on capex, but actually they're ultimately going to be one of the AI winners. No one's going to replace Microsoft Outlook, Microsoft Teams. So once they can actually layer in the AI features, and their cloud growth is growing 30-40%. We think they'll actually do well, and the pullback that we were kind of expecting has largely played out. So we think that's interesting. But we think the rest of the Mag 7, obviously more cyclical. Google and Meta have big advertising businesses. So if the consumer comes under pressure, they're going to be under pressure. Obviously, Amazon have a logistics problem now and a consumer slowdown problem. So Microsoft probably just as the most defensive out of the Mag 7, we own a little bit.
Well, look, it's definitely active fund management anyway, that's for sure. It's rare that I see a fund fact sheet changing as much as I noticed yours did, but look, it's for all the reasons you mentioned, so that does make sense. Okay, so Diarmaid, let's say when we're talking about those multi-asset funds, right? So obviously equities gets the big talk and bonds does get a mention, right? But do ye hold any? Is it mainly Euro government bonds, or do ye take? Because look, when we look at bond rates and we see that the likes of Europe at about 3% and 10-year bond yields, and you've the UK, it isn't far off 5%, right? Are you ever tempted to do something like that? Go for something outside the Eurozone to get the higher yield? Or do you very much say, look, it's not worth it moving into different foreign currencies, we'll just buy Euro bonds and keep the bond bit a bit simpler?
We largely are in Euro bonds, but no, we do certainly, we wouldn't go as far as now any emerging market stuff, but certainly US and UK, we do think gilts around 5%, certainly interesting. US long end similar. We think those, you're obviously picking up a little bit more on the yield side. We do think they're interesting. And also because our view on currency, we actually feel the dollar here is, it's obviously moved a bit in our favor recently, but overweight the dollar has been a big position for us, just because the relative growth rates of the economies. We felt there was a bit of maybe over exuberance around the German stimulus and what that could do for European growth. So just if you look at the relative growth rates, we thought there was a bit of a mispricing there, and particularly now in this energy shock, we actually feel the USD and obviously then US government bonds are an interesting, are actually a good kind of safe haven trade.
So would that mean if you kind of like the dollar as well, that you wouldn't bother hedging back to euro or on the bond bit, or would you hedge back to euro?
No, at the moment we don't. We're overweight dollar, so we keep our dollar. Yeah.
Okay, I have you. Okay. No, that's it for me. Thank you very much, Diarmaid.
So other questions. Eoin, this is one for you. It says annuities are not index linked generally. Is that correct?
Oh, well, you have the choice. I mean, that one of my slides there gave 4 different pricing options, and one of them was you can set it so that you want it to go up at 3% every year. So any element of having an increasing annuity, having one that's index linked, very expensive. So what you're doing is you're giving up an awful lot of income now, in the hope that you live a long life and you get it back. So, for somebody who was thinking about the level annuity, I mean, we were saying that that's about 20 years to get your money back, right? An indexing annuity would take longer just to get your capital back, but where it would prove to be I suppose a good decision is if you happen to live long past kind of average life expectancy. So it is possible, but they're priced accordingly, and the price will turn. I suppose a lot of people do mention, if they're talking about annuities, oh, I like the idea of it going up to 3%, but when you show them the price of that, they kind of turn away from it. But it is possible to have it.
Okay, thanks, Eoin. Question for you, Diarmaid. It's if the war in Iran ended now, do you see issues with future oil supply to future due to damaged infrastructure?
Yeah, absolutely. So the longer, so we've seen first in Iraq and Kuwait, and we're starting to see it now in the UAE and Saudi, that because obviously there's only a limited amount of storage, they're having to shut in production. So the longer a well is shut in, the greater the risk that it gets permanently damaged. So particularly if this goes on another, month or two, there's risk that the wells will be damaged. So, there's issues with pressure on some of the equipment. So it's quite possible that some of these oil fields never get back to the original production rates that they were before. So that's definitely a risk, we think. And then obviously on the gas side, the damage to Qatar's infrastructure, like they've said, that's going to take 3 or 4 years to repair. So absolutely, even if this ends tomorrow, there's kind of long-lasting impacts on the energy market. They're going to take some time to resolve.
Okay, thanks, Diarmaid. And then another question for you, or questions, like I get two different ones here. Is one person just, these are in connection with the Mag 7. Will SpaceX IPO, will that become will it become the Mag 8? And what about Apple?
SpaceX is an interesting one, because if you look at even Tesla, for example, we've always found the valuation difficult, and anything Elon Musk touches seems to, obviously because he's been an amazing engineer, putting everything else aside, anything he touches seems to get a premium. So we think it'll probably generate some interest. And the Nasdaq have actually made some exceptions to the index that essentially mean it's actually going to be included pretty quickly in the Nasdaq 100. So that will obviously generate a lot of passive and flows through that. But for us, I mean, when he talks about data centers in space, like we're not sure if that's imminent. Maybe in the long run, but it's not something we see. So it's probably not something we'll get involved in, certainly initially. And in terms of Apple is interesting here on a relative basis, just because it's probably, along with Microsoft, the kind of one of the lower risk large tech stocks. Now there is obviously a bit of risk if the consumer comes under pressure. Do they need to upgrade their phone? But it probably holds up reasonably well in this risk-off environment. The other thing that people have been a bit worried about is the memory shortage. But actually, Apple seemed to be using that as an opportunity, because essentially to take share in the kind of more mid-tier market, some of the other competitors can't really afford to release new products with this memory crisis. So they're actually using it to kind of move down market and take some share. So Apple here is, I would say, a reasonable opportunity on a relative basis.
Okay, thanks, Diarmaid. And then another question is it, given the the falls in the last week or more in the markets, is it time to hold tough, or when do we see it as an opportunity to buy more?
Yeah, so like for these situations, kind of like this time last year, 2022, even COVID, we look at positioning and sentiment data quite a lot to guide us, along with valuation, to guide us as to when we're kind of at levels of capitulation, and what positioning washed out and time to get back in. And historically, we've actually done quite well out of these opportunities in terms of having cash like we do now to invest at the bottom. But we don't think we're there yet for a number of reasons. One being that valuation chart that I highlighted. Like while the market's come back a bit, it's off really extreme valuations. So like markets are still at quite expensive valuations, and that's before, we haven't actually seen the earnings downgrades yet. We're going to obviously going into earnings season in a couple of weeks now. We're going to start to see numbers move lower, which will make the market look, optically more expensive again. So we think there's more to go on the derating side. And then the positioning data we look at, like we were astounded actually by the amount of complacency the first 2 weeks in March. People were saying, oh, this will be over in a month. It's not a big deal. We don't want to de-risk. And certainly, we saw it in the kind of last week was really the first time we saw a bit of panic. But we think when we look at positioning as well, there's still a lot more to go before, signs of a durable bottom. Now in these markets, you'll certainly get days like yesterday when, the market's up 3%, everything looks great again. But then, it ends up just selling off again for the rest of the week. So we expect kind of more choppiness, volatility, but ultimately we think it's too early to be getting too aggressive anyway.
Okay, thanks, Diarmaid. And a question for you, Eoin. This is if the 25% tax-free loan for 25% tax-free loans over 200,000, is the tax payable at 20% for that next 300, regardless of any other income?
Sure. So I'll just kind of give maybe two examples there, right? So if somebody had lucky enough to have €2 million on their pension fund, and they're going down to 25% lump sum route, right? So 25% of the 2 million is 500,000. First 200,000 is tax free. Next 300,000 is 20% only. It doesn't matter what else they have. They could have loads of rental income, loads of dividends. It doesn't matter what other income they have. If that's all they had, that's what they get. If they've loads more other stuff, that's what they get. So then the other bit, I mentioned there that there's another way to go at a lump sum, right? Again, not too many situations, but I have come across a few of them, and we have gone down the route where if you had somebody with a very high final salary, right? So now you'd be talking about something like about 333,000 or so, right? Because they could go down the 1.5 times salary route. So 1.5 times the 333 will get you to 500,000. That's another way to be able to get lump sums down, the first 200 tax-free and the next 300 at 20% only. So very much standalone situations. It doesn't matter what other income you have, whether you have loads or whether you've none.
Thank you, Eoin. So then for Diarmaid, we have a question here is, what do you see as the immediate future for pharma stocks?
Yeah, that's an interesting one. So last year, the big debate was around, two tariffs, first of all, which they've actually, shown that they've been able to navigate that pretty well in terms of their supply chains. And drug pricing, there was the big concern, but there was a few deals announced in kind of September, October with the US administration, which basically, if you spend a bit of capex in the US, will give you pretty favorable, drug pricing deals. So the sector had a decent run on a relative basis kind of late last year. And from here, it's probably, I think the absolute upside probably is okay, but on a relative basis, it should hold up well because it is viewed as a defensive, defensive place to hide. The other interesting thing, this is kind of very in the nascent stages, but the life science tools who provide these guys with their R&D and their testing equipment, they've actually been coming under pressure recently on the perception that AI is going to automate a lot of this, and they'll be able to do a lot of their testing virtually. Now that's kind of TBD, but there could be some, some upgrades there if they can reduce their R&D costs and help their margins. So that's something we're starting to look at, but it's kind of early days there. But as a kind of defensive place to be, it's not the worst place.
Okay, thanks, Diarmaid. Then I have a question here about a stock called Palantir, which is an AI play. Have you any views on it and its process going forward? Because there's a big pullback in recent months.
Yeah, I mean, Palantir is a very interesting one. It's it's because the valuation is it's probably the most expensive stock in the market. But what they do as a company is unquestionably very impressive. Like I met the CFO from a US utility company 2 days ago, and he was telling me they've started working with them in last September, and they're already seeing a huge ROI and huge just efficiencies. Like one of their big kind of caps on their growth is how quick they can get projects submitted to the regulator, and it used to take kind of 3 to 4 months, and now with Palantir kind of just collating all their data from various sources and putting different pieces of the company together, it's taking them 20, 30 days. So a huge improvement in what they can do. So like we certainly wouldn't be concerned about their earnings trajectory. It's just what multiple you pay for it. So it's probably a stock that's certainly interesting in picking up, but just it is obviously given it's a tech stock, it's kind of a risk on stock. So if if markets are going to be choppy, there could be a bit more downside, but long term as a company, it's certainly, I think, going to be one of the big AI winners.
Okay, thanks. And so then this question came in about Microsoft, where it was a general question about because its shares and other shares are denominated in US dollars, and do you take currency views in framing investments as the share price increase could be offset by a weaker dollar?
So we can do, and we have in the past. But as I said, at the moment, given our view on the dollar, we run them unhedged. Now that's if the dollar strengthens materially, we might look at hedging it up. But at the moment, we think we're comfortable being long the dollar versus the euro, so we're happy to run them unhedged.
And then sort of more colloquial question then is our broker is about CRH. Any views on CRH?
CRH is when they move to the US to get the re-rating versus US peers, they probably still haven't fully got the credit. If you look at the relative valuation between them and Vulcan or Marietta, there's probably still a bit of a valuation discount there. So, we would expect over that to close. There's a bit of uncertainty in the US about the US infrastructure funding that was under the Biden administration, the IIJA. A lot of that hasn't been allocated, and it expires next year. So there's a bit of a race on to actually get projects allocated. So this infrastructure is about 40% of CRH's business. There's a bit of a race to get that allocated. So that's something that could maybe pose a bit of an issue if it doesn't get done. But fundamentally, it's not overly expensive. They're in good markets. That government funding point is just, I think, something we need to monitor.
Okay. I have a question. Maybe for Eoin, but it's just asking about the new government savings scheme.
Yeah. That's still, let's say, whatever. It's Simon Harris. Could we say good for electioneering? But a great idea, and we'll all benefit from it. So look, it's definitely do it, right? I know the details of it are still happening. But even when we look at pension funds, they allow tax-free growth in all the pension funds. There'll probably be some element of that capped at a certain level. But I can tell you now, do it, right? Just one other point I just saw when I was talking about the annuities, and the question was that they're not index linked generally, right? So I answered that in the context of defined contribution arrangements, and you've all these choices at the markets. I just noticed from the person's name, I know they're in a defined benefit scheme, so it's a slightly different answer for them, right? That's very much at the discretion of the provider of the defined benefit scheme, so the employer. So they tend to have no indexation on them, but on a discretionary basis, they can increase it, but they tend not to. So if you're in a defined benefit scheme at 65, you should expect no indexation, and that will be a level payment forevermore.
Okay, right. Thanks. We've got to the end of the questions, so I'll just thank Eoin and Diarmaid and all of you in particular for tuning in today. And if you need your CPD cert, be sure and email us, or if you want a copy of the slides as well, you can email either myself or Eoin, and we'll be talking to you again in October, hopefully for our budget webinar.